Hey traders, Steven here. It's Thursday morning, May the 30th. We're gonna obviously cover a lot today. There's a lot going on. We have, what looks like kind of a topping formation on the major indices. Russell's already just absolutely rolling over. So we're gonna look at that and potential downside targets unless it bounces today. Gonna look at some secondary indicators. I'm going to look at just a lot of different things of, if this turns into something deeper, possible expectations. So I really just want to get right into it. Start with the Nasdaq. This is a busy chart, but, we made a major run coming off the December 24th low. Excuse me, all the way up to the top. We haven't even, right here under the 200-day moving average where the price action stopped yesterday. We haven't even made it to the 38 retracement level. Definitely haven't made it to the 50. So one thing I want to look at is you got a couple things going on. One could say this is, a mini head and shoulders top, right? You got, the shoulder, the head, the shoulder, the break. But, what was really interesting to me is this neckline, I think had a definitive break yesterday where it just snapped. But right below it is this 200-day moving average. So everybody sees this as far as traders go as a bearish development. So you could, everyone's getting sucked in on the short side. But anything could happen right now. So I have this purple area, this purple arrow as a potential target. If we get a bounce. Even if we get a bounce and this is the low, I think that this area, this kind of 7800 level is where I would expect, the top of this bounce before it pulls back again. Because I'm looking right here and, I've noticed that the rally line, the 20-day EMA, it's usually going to find, in a correction, it's usually going to find rejection twice. And, I was talking about, hey, when we started getting a bounce a couple weeks ago when I did my webinar, let's watch the 20-day EMA, and it completely got rejected back-to-back days, and then it got slammed back down, broke the neckline, but found support at the 200-day moving average. If we get a bounce into this, we could get a bounce, and I would think that it would get rejected one more time. It could go straight out of here, but I would think it would get rejected one more time, whether this is the low or not. And I say that because if we get a bounce, it could come in here and then a low is put in and then a chop around a little bit and then it kind of punched through on the third time. Now, if I'm looking at the futures this morning, and in my opinion, it's not really a bounce. It's up like 0.25%, the overall market. So it's not much of a bounce, but it could strengthen into the day and into the week. Just be careful if we do get a multi-day rally because, these bounces are strong. They're always up over 1%. They can suck somebody in and just right before it slams it down. So if you're going to put money to work, it's probably sometimes better to stick your toe in the water right here than wait till it gets all the way up here or at least wait for a day or two of strength. So I think that if we do get that rejection a second time, obviously it could just break through this, or it could kind of, create a more cut pattern. So that's one potential. I'm showing you these scenarios just to kind of open, keep you open to anything that can happen, right? Anything can happen at this point in time. Another scenario, which if we don't get a strong bounce, if yesterday's low breaks, and I think we could pick up speed to the downside very, very quickly. I think it could reach the 50% retracement level very, very quickly. So, and why I say that is because, the market could be gunning for these stops, right? You have these stop run levels, this swing low right here. This is a minor swing level. This is not probably a potential support. It could be, but I think it's more likely for the market to pick that level off, pick this level off, this little pivot right here, and just kind of run all the stops, kind of have a waterfall effect where you have like 3-4 days in a row of just nastiness like you do right here before we get a potential bounce on the 50% retracement. So I just because of these two levels right here, I think that if this breaks, it could break very, very quickly. So I think right now we need to be open to a bounce into the 20-day, and then be cautious to see if we can put a bottom in, or we could pick up speed to the downside very, very quickly. If it breaks this level, obviously anything can happen between here and here. Then you have a bunch of other little levels the market can pick off, and you know, this could, I'm not calling for one big double bottom. Obviously that would suck, but I just want you to not be surprised at anything and just be completely flexible. If the downside happens, it happens, and if the market pops, you know, I think either way you should just kind of be cautious on where we're at, because I think these are the two levels on the upside or the downside that we can gun for. And right now I have no idea which level it is, but you know, when I scroll down here, let me kind of update this annotation. Here's what I know. That's a lot of distribution right there. That's a lot of institutional selling on the Nasdaq side. So it's just something to keep an eye on. You know, if we go over to the S&P 500, the chart looks, it's very, very similar, but I just wanted to draw a couple other things, so I didn't make the other chart too ugly. You know, I wanted to draw the potential kind of head and shoulders, the neckline, you know, break. I should have deleted that, and then I drew these stop run levels right here, right? If we get going to the downside, I think it could just, it's possible it just could pick these two levels off very, very quickly, and then potential settle down right under this stop run level right here, kind of in this zone, like it's going to pick it off. And, you know, if you watch a lot of my webinars this year, you know, once this day happened, right, and then the market looked like it was ready to get in kind of a super trend mode, you know, that I was talking about, it's very, very possible the market is going to just make it to the all-time high and then pick that level off before it corrects. That's exactly what it did. It had 1-2 days at an all-time high, picked off the shorts. I'm telling you this because if you don't believe, you know, how well sometimes just picking off these levels work, just look at what happened at the high. It just picked off the all-time high, and then it just absolutely started to correct. The Nasdaq was down, but it's down about 8%, so we're getting into that correction mode more than just a pullback. The bounces haven't been working yet, so you just kind of need to be cautious and trade a little bit less. If I go to the small caps, I didn't really mark up this chart because I wanted to keep it clean, but man, this really looks like, I mean, there's not really much of anything other than it looks like it's just going to kind of roll. Because, I mean, it's undercutting this, even though it probably closed above this level right here. But when you kind of have this and you have, you know, you could call flag breakouts and all this. I could draw all kinds of flags right here, and it just, a false move to the upside. You know, one thing Martin Pring says, false move to the upside could be above average move to the downside. I don't know about that just yet, but all I'm saying is when you don't have a lot of major support levels under it, it could pick up speed. So just kind of something to keep an eye on. And kind of to go back, I always like to look at past corrections. So when I talk about this 20-day EMA, you know, rejection, how it can get rejected twice, I want to show you that it's more of an art than a science. So if you're going to call me out and say, Steven, it did not touch the 20-day EMA twice, I'm going to show you what's happened in some of the past corrections. So, you know, this is a 2010 correction, and these were waterfalls. And I wouldn't say we've had a waterfall yet. I would say we've had some grind lowers. I wouldn't call what we're in right now a waterfall. But look how it bounces once, and then it comes back down, and it bounces again, rejects twice, and then the third time it goes through. Now, obviously, that third time it went through, and then it failed again. But I'm just really trying to prove a point, just so you can have an idea and kind of let history be your guide. This really only rejected, I would call it once. You could argue that it bounced right here, tried to hit the 20-day moving average and came down, hit it again. See, it's not going to be textbook where it's just going to get a clear-cut bounce, come back in, clear-cut bounce, come back in, and then it breaks through and starts chopping around for a while. So that was 2011. Now, if we look at 2015, see, they all look different, and that's something to just kind of keep in mind. If you're just waiting on classic patterns look good in a book, but then you get in the real world, and that's not how they always look. That's why I say it's more of an art than a science. You got to bounce close to the 20-day moving average. This is a 2015 waterfall. And then it got rejected, and then you got close again, and then it got rejected, and then it punched through the third time. So on the last, 3 major corrections, I'm not including last year because even though I could, because it was more of a bull market, but in the last 3 major corrections, it took 3 times to punch through, went up a little bit, and then it started to chop, right? Then you kind of get no man's land where it just kind of chops on the bottom for a little bit. So that happened in 2010, 2011, and 2015, where 2 rejections, a breakthrough, suck everybody in, and then it starts to pull back under and chop for a little bit. So that is why, if I go back to the Nasdaq chart, that's kind of why I want to tell you that, we could get another rejection and then a pullback, and it could surge in here and then suck everybody in and then get another pullback and chop for a little bit before. It's just going to frustrate the bejesus out of you, and that's the market, right? You don't like whipsaw. I think Ed Dakota says if you don't like whipsaws, you don't need to be trading. It's just part of it, and you got to be willing to deal with that. You lose a few in a row, cut your position sizes in half. There's all kinds of things you can do to your risk model to say, okay, if the trades aren't working, obviously you can look at the market and say, okay, the market is not doing so hot, but if I see a setup I really like and the market's still looking questionable, then just cut your position sizes in half. It's very, very simple. You don't have to continue to revenge trade. I think that is the silliest thing you can do is revenge trade, try to make it all back, and then you just, it typically never works out well. So I always, look at the price, look at the volume, then I like to go to the breadth. Breadth's my next indicator, but it is a secondary indicator. I don't make trading decisions off them, but when I see price break and then the breadth has already confirmed it, then I respect the price break. So right here, you have only 18% of stocks in the S&P 500 above the 20-day EMA. That's not strong. That's not strong at all. You can see we've been grinding lower. It looks just like the market, and that's just kind of part of it. So what I do sometimes, though, this is more than obvious, and I show this peaked right here because the short-term breadth peaked way before the market did. So sometimes it's just kind of interesting to see, and most of the times breadth will peak before the market. So towards the last, 10 to 20% of the rally, you'll have, fewer stocks pushing up the market. And then when a price breaks and you've already seen this and you're like, okay, I need to get out of the way. But I like to see if there's anything holding up, any pockets of strength in the more aggressive sectors. So I just kind of scroll through here, and I don't really see any because you have XLK, 22%. You want it really everything above 70%, or you want kind of the sector that you own above 70%. Financials at 28%. Consumer discretionary at 7%, those are weak. Industrial 14%. Healthcare is 25%. Staples is 18%. So even the defensive stocks are looking like crap. Energy is looking the weakest at 3%. And then you have materials at 7%, and even utilities are only at 21%. So out of all of these, I would say financials are looking the best, but that is a low bar. When only 28% of the stocks in this index right here are above the 20-day EMA, that's a low bar. That's not, this just shows me there is broad weakness even in the defensive names. So, nothing really great on the breadth side. It's obviously confirming the price action. So, on the longer term breadth chart, which is kind of what I prefer to look at because there's not as much whipsaw, you have the percent of S&P 500 stocks above the 200-day moving average. Right now we're at 50%, so we were up at 80 and now we're at 50. A lot of stocks are rolling over. In the, if we go back to, but but I think we're still okay. Like, this is still only an 8% correction in Nasdaq, maybe slightly less than the S&P 500. You know, if we go back to really the last couple corrections, now obviously you have the bear market went way down here, but you know, you look 2015, 2016, we got to around 20%, but the markets were down, I think, 14 to 15, 16% on each of those legs. And you had some shorter corrections at the beginning of 2018 where we did get down into that between 40 and 50 level. So that's kind of where we're at right now. But you know, this is going to go with the overall market. So just right now, 50%, that's just not really a trending market, obviously based on the price action, but that's just something extra to confirm. Right here, I have the sector summary, S&P sectors, looking at all 10. And for the last 1 month. And you can see right here, this completely makes sense. REITs, utilities, and staples, the defensive, are the strongest three. Healthcare is kind of all of a sudden hanging in there, and that, which is interesting because it really absolutely rolled over a couple months ago, and then it bounced back. But then you have really discretionary technology, energy. Energy is looking the weakest. Technology is you know, next, so a lot of sell-offs in the more, you know, more aggressive sectors. So let's look at, oops. Okay, so just kind of looking at, the industry summary. So what I'm going to do is let's just go to the 1 month. So what I'm going to do is I'm going to look for little bitty pockets of strength, right? Like we did a couple weeks ago. You know, we looked for a couple stocks. Actually, we ran a scan a couple weeks ago. But, you know, the industry is, you know, every sector, there are 10 sectors, and then they're broken down into 5 to 10 smaller industries. As you can see right here in the communication services, internet, right? You have fixed line, the telecommunications is up, but then the internet is weak. So that's why sometimes, like, it really helps to kind of break down into the sector and buy the individual industry ETF versus the overall sector, because you're going to get, you know, all of these mixed in, which could produce a negative result. Whereas if you went for a telecom ETF, then you'd probably have produced a positive result. Okay, so telecom, there is some pockets of strength in telecom in the last 1 month. Boy, that looks a lot of red in discretionary. So consumer staples, soft drinks, that's pretty defensive in nature. Tires, wow, that's down 25%. Okay, energy, renewable, there's a little pocket of strength in there, but if I kind of go back up here, telecom up 3%, renewable up 2.5%. Life insurance, I'd say that's the full line insurance. Say life insurance, there is some broad strength in here in the financials. So it's probably the insurance industry that is propping up the financial ETF or the financial breadth that we looked at. That was at 28% of stocks above the 20 EMA. So insurance stocks could be a pocket of strength, or you know, sometimes, like, you're looking for these pockets of strength, but when the market is selling off, is in a correction, you're looking at what's holding up the best. And in a bear market, everything's going to just get slaughtered most of the time. But in a correction, there could be 1 or 2 industries that really don't budge. And sometimes that just means that, you know, when the uptrend continues, that those could be some areas to look at. Industrial, defense, that's just all red. Materials, gold mining, miners, they all kind of look like crap to me. I don't really like it. I mean, they're not trending up. They are not, you know, countering the pullback. There's just not a whole lot going on there. REITs, you can see some pockets of strength within the REITs, but what's interesting is the mortgage and the real estate REITs, they're down. Some of these, there is a residential REIT that is up, but some of these specialty REITs, they're up. So then you have water utilities. So not a lot. I mean, you see a lot of red in the last 1 month. I'm just, you know, I'm going to go for something that's standing out a little bit. So I'm just kind of looking at some of these. It really looks like some of the big guns, you know, like AIG. I think that some of these are some larger names. Let's just kind of look at this, just because I know that. Actually, I want to look at this. Something's up 17%. That looks pretty thin to me. I want to look at the weekly chart. Kind of back this out. I mean, it's interesting. It went from 7 to 37, then it's just in a multi-year consolidation. But this looks like it's starting to climb out of this. You had, you know, a nice move off the bottom. Outside of this bar, you had a nice sideways consolidation. Kind of a reversing candle, probably an earnings gap, and it's off. So that looks interesting. I just kind of want to look at AIG for a second. Yeah, and I'm sure this is an earnings gap right here too, but it always just interests me to look at stocks that, you know, when the market's correcting or there's a bear market, you look at it and it just says, what correction? It doesn't bother me a bit. So, I don't know if this is something. I'd probably wait for some kind of a pullback or a base before, but these are some kind of tall climbing, right? And that's kind of bullish right here, even though it's looking like it's kind of approaching this. But I would bet that if it pulls back, it's just going to kind of create a cup, a pullback, whatever, and then it'll probably clear these levels just kind of based on this kind of a climb, this kind of a price action. Just looking at TLT real quick, I mean, this just kind of goes to show you the environment. I mean, you had just a major, 2-year downtrend in bonds, and then it's just absolutely going on a tear. TLT is up, the 20-year Treasury ETF. So, I mean, that just kind of shows you we are definitely, without a doubt, in a risk-off environment. Money is pouring into bonds, pulling out of stocks. Be interested to watch this, because if you look at this the last couple times, right, you know, it surged and then it pulled back, and then it surged, it broke this pivot, then it pulled back, and now it surged, it broke that pivot. So if you follow the path a little bit, this could pull back, which means we could get a bounce. Of course, it just could accelerate, but the last couple times, this might be the time where it pulls back. So I'm really just keeping an eye on stocks, just kind of see absolutely what they do, kind of go from there. One interesting note that I did want to show you is, you know, this is the S&P 500 versus the VEU, the All World ex-US ETF, and international stocks the last couple times have really led the market lower. You know, if we look right here, they peaked. This was at the peak in 2018. They peaked on the same day, right? Well, the purple line is the world stocks, and the green and red is the S&P 500. Well, when the market came back, that, you know, the international stocks never really came back with it. So what was interesting is the U.S. stocks, you know, peaked, but the international stocks were already going down. Well, right here, you pretty much have a peak right about here, and you can see, now I tried to retest that, but you can see again, international stocks peaked on this bounce before U.S. stocks, and U.S. stocks kept going for a little bit, but international stocks just couldn't break higher, and then led the U.S. market lower. So I'm just saying that the last couple times that we've had a couple corrections or bear markets, international stocks have broken first. So sometimes this is just an extra data point that you can use if you're, you know, looking to do a little bit more analysis. A couple of interesting things that, you know, we've been talking about in the group that I wanted to show you is, you know, some of these grain, agricultural commodities all of a sudden are kind of popping out of nowhere, and it's interesting because out of the 248 ETFs I have on this list, I typically rank it by 3 months, because I'm like, okay, when is a trend going to start, right, from a relative strength? So you can see corn, cocoa, and wheat out of 250 ETFs in the last 3 months have really really dominated this list. There are 3 of the top 4. You can see you got a couple Indias up here. We can look at that in a minute. I'm pretty sure that has to do with the election. But this is pretty interesting. So I always say, like, you know, an ETF, a stock, whatever, an investment has a personality, and that when that personality changes for the better or the worse, it's kind of time to pay attention. So if you look at just this corn ETF or ETN, whichever one it is, it looks like an ETF. It's just been in a downtrend. Now, obviously, you got, you know, the commodity costs and all that stuff, but my point is, all of a sudden, it's been in a downtrend for years, and all of a sudden, you really get a surge out of here. Now, I'd say, I wouldn't call this a surge, I wouldn't call this a surge, but I would call this a surge. Now, the last time the surge happened, it just absolutely gapped down. But look at the volume that's piling in on this time. It sure didn't happen last time, right here, like it is now. So it really surged out of here very, very quickly. It reversed yesterday. My only point is I would really keep an eye on this. A lot of times what will happen is it'll surge above the long-term moving average, and then it'll pull back under and kind of find support at that 50. And if it does, if it creates any kind of reversing bar around that in this level, it might be worth a stab, because you just never know. If this ship, this is here, let me go to the monthly. This is one hell of a, could be a potential turn, right? And look on the monthly chart, it's got the most volume it's had since 2014, from an accumulation standpoint. So I would say the personality is changing. I'd say this is not a good entry right here. It's a little bit extended, but I would definitely keep an eye on this. And Cocoa didn't surge out of it as strongly, but you know, it kind of created this little cup with handle, and now it's kind of trying to get out of here from a 3-month relative strength. It's very strong. If we go to the wheat fund, it looks similar to corn, where all of a sudden it surged out. It reversed yesterday. This could turn into absolutely nothing, but I really like this 3-month because I'm like, okay, it puts things on my radar, and then I can keep an eye on it to see if something develops. And I mean, I will definitely take a swing at the bat, you know, just looking at some of these monthly charts, and I say, okay, if we go into a long-term commodity, or at least agriculture commodity bull market, and you got the turning point, I mean, that could be very interesting. Now, of course, it could base the bottom for years, it could go back down, but it's starting to look a little interesting is all I'm saying. Let's look at India real quick, just because we have it here. I believe Modi won the re-election, if I saw correctly, but you can see this India ETF. Let's just look at the weekly chart. It already bounced. So the U.S. market, you know, went into a bear market just like the U.S. market, came back, you know, kind of touched close to the all-time high, already came back, tested the long-term moving average, which we're down here now, and then it came back and is at a 52-week high, almost at an all-time high. At least this ETF is. So a lot of accumulation stepping in. That's probably anticipation of the election. So I don't know if this is the best entry right here, but maybe it drifts down a little bit and retrace. But you know, you can see these other industry ETFs. See, the small cap hasn't done near as good, so I would focus on the large cap. And this INDA looks the same, but I mean, if I have to choose, I'm going to take the one that's slightly better, and this INDY is slightly better. And you can see we saw the insurance. The insurance is at a all-time high, this insurance ETF. And we noticed that on the industry summary side. And we already looked at the TLT, so that's way up here. You can see that is surging out of here. So, you know, it's definitely changed, because a month ago technology was up, but look at this DBA. This DBA is up here, and this is the Invesco Agriculture ETF, because all of a sudden you have some of these ag ETFs start to move. So this is still a very, very bad looking chart, but you know, just kind of keep an eye on it. So I hope this was helpful. Let me know if you have any questions.